In 2026, your money does not just sit quietly in a bank account. It does not sleep. It does not forget. It does not remain neutral. Every transaction sends a signal. Every payment generates data. Every decision feeds a system designed not just to move money, but to interpret behavior, assess risk, and anticipate your next action. Money has become communicative. It reports, it adapts, it reacts, and in some cases, it decides. You were taught that money is something you earn, save, and spend. But in 2026, money has become something that evaluates you continuously. It knows where you shop. It knows when you travel. It knows how quickly you respond to prices. It observes your patterns, your tendencies, your habits under stress. It understands you in ways no single human institution ever could. The most important shift is this. Access to money is no longer something you request. It is calculated. You do not apply. You are scored. The system does not need to deny you openly. It does not need to justify itself. It does not need confrontation. All it does is adjust friction. A delay here, a verification there, a spending restriction that appears silently. Nothing dramatic, nothing illegal. Just architecture functioning exactly as designed. And it works because most people do not notice it, which raises a question few dare to ask. If artificial intelligence increasingly decides who gets access to money, who controls the system behind the AI, the transformation of money has been subtle yet fundamental. First, it stopped being paper. Then it stopped being physical. Then it stopped being something you personally held. Now it is programmable, monitorable, and modifiable in real time. Digital currency is no longer theoretical, it is operational. Central bank digital currency pilots are moving beyond experimentation. Digital wallets linked directly to national frameworks replace traditional bank accounts. Payment rails clear instantly. Cross-border transactions settle in seconds rather than days. The convenience is undeniable. But convenience always comes with a hidden cost. Cash was private, inefficient, and untraceable. Credit cards were efficient but traceable. Digital currency is efficient, traceable, and controllable. That is evolution, not accident. For decades, digital payments relied on commercial banks as intermediaries. Now, central monetary authorities are building direct-to-citizen systems. This is not about replacing banks completely. It is about ensuring that the authority issuing the currency has visibility, influence, and oversight over the flow of money in real time. Programmable money enters the picture in new ways. Imagine stimulus funds that must be spent within a specified period. Imagine benefits that only activate in certain zip codes. Imagine automatic restrictions on spending categories. These features are often justified as safeguards, fraud prevention, targeted economic relief, disaster response, and sometimes they are effective, but they also remove neutrality. Money stops being just a medium of exchange. It becomes a policy instrument, a tool for influence, a mechanism of compliance. Artificial intelligence accelerates this transformation. Decisions that once required committees, analysts, and human discretion now happen in milliseconds. Risk is scored, patterns are flagged, enforcement becomes frictionless. There are no phone calls, no explanations, no negotiations. AI does not invent the rules. It enforces them at scale, continuously, consistently, without fatigue or deviation. In 2026, control does not look like a person pulling a lever. It looks like layered institutions drafting frameworks, regulators defining compliance thresholds, engineers coding transaction logic, cloud providers hosting the infrastructure. Power is distributed but aligned, fragmented yet coordinated. Accountability dissolves across layers. Monetary authorities define the structure of the digital currency and decide circulation. They set parameters. Governments attach regulation, identity verification, and compliance mandates. Real-time taxation, instant stimulus, and behavioral monitoring are not hypothetical. Spending patterns can be analyzed at scale. Efficiency and stability are prioritized. In moments of crisis, this is framed as public service. In moments of stability, the same infrastructure allows for surveillance potential. Private tech companies provide the backbone of this system. Servers, cloud infrastructure, cybersecurity frameworks, identity verification, analytics platforms. Machine learning frameworks. Many AI systems analyzing behavior and financial risk are developed in the private sector. The result is a hybrid system: public authority, private execution, automated enforcement. While governments set the rules, private companies power the rails, manage the data, and maintain uptime. AI enforces rules, monitors transactions, and evaluates risk. It does not judge context. Fraud detection systems scan millions of transactions per second. Anti-money laundering algorithms evaluate networks of behavior. Credit scoring models update continuously. Identity verification systems confirm presence, location, and consistency. Each system seems reasonable individually. Together, they form a continuous, automated evaluation environment. Discretion disappears. When a human analyst previously handled a case, there was room for context, error correction, and explanation. When an algorithm flags a risk, the flag becomes the truth. Appeals exist but are slow. The burden shifts to individuals to prove innocence in an opaque system. This is not dystopian fiction. It is operational reality in 2026. Programmable money accelerates this further. Benefits can be region-specific. Subsidies can restrict categories. Relief funds can deactivate after a set deadline. Efficient, targeted, responsible, at least on paper. But behavioral steering emerges. Choices narrow. Compliance is monitored continuously. Self-censorship arises not from active surveillance but from the potential system reaction. Stability and freedom exist in tension. Cash favored freedom. Digital systems favor stability. Transparency reduces abuse, but also reduces privacy. Programmability reduces misuse, but removes neutrality. Control is layered. Monetary authorities control issuance. Governments control regulation and identity. Technology providers control infrastructure. AI controls enforcement. International institutions influence standards, aligning systems globally. Digital currency is not isolated. Financial systems are interconnected. Standards are harmonized. Rules converge. Data frameworks expand. When one economy adjusts, others adapt. By 2026, digital currency is a global transition. Different speeds, same direction. AI integrates deeper. Composite scoring dominates access. Income, credit history, behavioral patterns, location, network connections, device identity, everything feeds the model. High trust scores experience seamless access. Low trust scores encounter friction. Most of this is invisible, until it isn't. Convenience sells change, tap to pay, instant transfers, smooth, effortless. The trade-off is privacy versus frictionless design. Decentralized cryptocurrencies promise alternatives, but even these systems face growing regulation. Exchanges require identification. Oversight expands. Wallet tracking improves. Institutional participation grows. True decentralization is difficult to maintain at scale. Most Americans remain inside regulated digital financial systems. The real question is governance, transparency, oversight, appeal mechanisms, clear boundaries. Digital systems are not inherently oppressive. Opaque systems are dangerous. Rules without visibility make power unchallengeable. Automated enforcement erodes trust quietly. By late 2026, expect expanded central bank digital currency pilots in major economies. AI will deepen its role in compliance. Cross-border settlement networks will accelerate. Digital identity systems will integrate more tightly with financial access. There will be no collapse, no dramatic upheaval, just gradual normalization. Money feels easier. That is why the shift is so effective. It does more than move. It communicates, signals, adapts. The system is complex, layered, institutional. AI does not rule society. It executes frameworks created by policymakers, engineers, and financial authorities. Who really controls digital currency? Those who design the rules, those who define the parameters, those who decide what the system optimizes for. Power is embedded. AI may decide outcomes, but the system decides AI, and the system was built by people. Citizens now face a choice. Will the public demand transparency, limits, and accountability, or adapt quietly to whatever version is delivered? That decision is not automated. For now, it still belongs to us. Imagine a world where your financial behavior is continuously assessed, where spending a certain way can affect your access to services, where small choices ripple through algorithms in ways most never see, where freedom is measured against compliance, where stability is measured against control. This is not the distant future. It is happening quietly, layer by layer, transaction by transaction. The architecture of money is evolving before our eyes. And with every step, the balance between convenience, efficiency, and personal freedom shifts. Every swipe, every tap, every digital payment, every automated transaction, every programmatic restriction, it all signals, it all counts, it all feeds the system. Behavioral economics is no longer theory. It is real-time application. Algorithms adjust, incentivize, and restrict. Money itself guides actions. What once took policies and committees now happens instantly, at scale, without human intervention. The system rewards conformity, punishes risk, optimizes behavior, reduces variance. Stability becomes the default. Privacy becomes the cost. Financial inclusion looks different in 2026. Some enjoy seamless access. Others face invisible barriers. There is no paper notice, no phone call, no human explanation. Only the algorithm's quiet enforcement. Global coordination emerges. International standards align. Digital currencies in different nations adapt to maintain compatibility. Cross-border trade depends on protocol adherence. Data flows silently across networks. Regulators watch from multiple angles. Tech companies maintain infrastructure globally. Programmable money spreads. Incentives embedded in code. Restrictions embedded in logic. Economic behavior subtly nudged. Spending patterns encouraged. Choices guided. Freedom quietly constrained. Even small decisions are scored. Your creditworthiness, your access to loans, your ability to invest, all measured. Behavioral scoring grows in sophistication. AI interprets signals you may not even know you're sending. And still, the majority do not see it. They experience convenience. They experience speed. They experience efficiency. But beneath the surface, every action is part of a continuously evolving system. This is not a conspiracy. It is the natural outcome of efficiency, programmability, and AI integration. Control is subtle, embedded, and distributed. No one person holds it all. But the architecture ensures outcomes align with the system's objectives. Privacy is no longer assumed. Neutrality is no longer guaranteed. Freedom is no longer inherent. Access is earned not just by effort, but by alignment with program norms. Yet the system can be questioned, challenged, monitored, governed. Transparency is possible. Regulatory oversight can exist. Appeal mechanisms can work, but only if civic engagement demands it. The future of money in 2026 is not just technical, it is civic, it is societal, it is personal. Every participant in the system has a stake. Every choice matters. Every transaction contributes to the larger framework. Digital currency communicates, signals, adapts, enforces, influences, guides, rewards, restricts. Artificial intelligence does not rule. It executes, it interprets, it scores, it flags. It enforces the rules designed by humans. And that is why understanding who controls the system matters. Because the system controls AI. And the system was built by people. In 2026, digital money is everywhere. Embedded in wallets, embedded in devices, embedded in commerce, embedded in infrastructure. It is fast, convenient, efficient. And yet, it is measured, monitored, and modulated. Power is quiet. Power is invisible. Power is embedded. It flows through frameworks, through layers, through institutions, through algorithms. AI decides outcomes, but humans decided the parameters. Humans designed the system. Humans built the rules. The system reflects priorities, efficiency, control, compliance, behavioral alignment, transparency, only if mandated, accountability, only if enforced. For citizens, the challenge is understanding. Understanding the architecture. Understanding the consequences. Understanding the trade-offs between convenience and freedom, between speed and privacy, between stability and autonomy. The choice remains ours. Demand oversight, demand transparency, demand limits, or adapt quietly to whatever the system delivers. That decision is not automated. It is human. It remains human. For now, it still belongs to us. If this analysis helped you understand the future of money in 2026, share this video, leave your thoughts in the comments, and subscribe for more in-depth breakdowns of the systems shaping our world.